All right, we'll give everyone just another minute or two to get logged in, and then we will get started. All right, everybody, it is top of the hour. We will go ahead and get started. So just a few reminders before we hand it over to Tanya here. All of our phone lines have been muted, so if you do have any questions, please use the Q&A box located on your menu bar, or you can use the chat feature. Any question that needs immediate assistance, I will go ahead and answer. Otherwise, all questions relating to the presentation, we will hang on to the end. If you're looking for CPE credit today, please keep in mind each participant must be logged in on their own. Group viewing will not count for CPE credit. You must stay connected the entire time, and you must answer all of the polling questions. We will email out your CPE certificate within 10 to 14 days after this session. All right, we're going to go ahead and turn it over to Tanya here and get started. Tanya, if you click on the screen, you should have control.
Perfect. Thank you, Amy, and thank you everybody for joining our webinar today. We have quite a bit of information to get through today, but first, as many of you know, my name is Tanya Rule, and I lead the Affordable Care Act services for Eide Bailey. So anyone who has listened to my webinars before knows that anytime it comes to the ACA, I could talk forever. I will be cognizant of your time and get you out of here in an hour. That being said, if we spend a little bit of extra time on the slides that I feel are more pertinent, we will skip through some slides if I see the time is getting away from us. Please read through those slides and email me if you have questions on them. You have my contact information at the beginning of the webinar on the side as well as at the end. Give me a few days to respond back, as I have quite a few things on my calendar over the next couple of days. So with that, let's go ahead and get started. So today we're going to review some new items under the Affordable Care Act. We'll visit those penalties again. Nothing new has changed as far as the employer penalties, other than obviously they've increased a little bit due to inflation. We'll talk about the measurement periods, both the monthly and the look back. We're not going to spend too much time on those as they have not changed at all. We will talk about the reporting requirements, both the B forms and the C forms, as well as some coding examples and some common misinterpretations of the ACA. So let's talk about some of the ACA updates. Obviously, the repeal of the Cadillac tax, not done yet, but it does have bipartisan support. That is not slated until 2022, so we'll see what happens with that. The economists out there are not in favor of the repeal. Obviously, they need those dollars for the funding. No decision yet on that Texas versus United States court case, so we're still waiting to see what happens with that. Remember that that's on the constitutionality of the individual mandate and whether the whole entire ACA would then need to be overturned. New out there are some more states are coming to the table requiring individuals to have insurance. Remember, we'll see in a future slide, that federal mandate is gone. We do have some states stepping up to the table saying, hey, listen, you have to have individual insurance. You have to have, insurance in our state. Otherwise, you will pay an individual penalty. The states that came to the table for 2019, we have New Jersey as well as Washington, D.C. Remember, we had that in 2018 for Massachusetts. Then come in 2020, we'll have California, Vermont, and Rhode Island come up to the table. We do have a handful of other states that are looking at it as well. What does this mean for employers? Well, you need to know that if you have an employee that resides in one of those states, you could potentially have a filing requirement. under the Code Section 6056 as a large employer, or under Code Section 6055 as an employer with a self-funded plan. Currently, New Jersey and Washington, D.C. allow the forms that we have right now to be uploaded to their state. If those forms change, remember we don't have the forms out yet for 2019, if they do change, you're going to have to go back to that state and see if they've changed the requirement. Some ACA terms. We'll go through quite a few of these terms. One term I want to hit home on right away is applicable large employer. So we have been doing these round tables where employers can submit questions to us, and then we have a 30-minute round table where we just simply go through the questions that were submitted and answer them for the individuals that logged on and asked the questions. This question comes up multiple times. And the question out there is, am I a large employer? It seems like an easy question on the outside, but it really isn't. A large employer, that is someone with 50 or more full-time equivalent employees. Nothing's changed there, but just to reiterate how that's done, it's based on 120 hours, not 130 hours. That 120 hours, if you work 120 hours or more a month, you are a full-time employee. Then you take all the other hours, divide it by 120, and that's your equivalency. You add those two up, and that's your number for the month. You do that for 12 months, divide it by 12. If you're at 49.99, you are not a large employer. Now, why this is important is because the IRS is sending out those letter 5699 forms, and those forms are saying, hey, we think you might be a large employer. Where are your forms? They're looking for those 1094 and 1095C forms. The IRS, as we'll see later on, is getting a little bit more aggressive in their notices, and you have to step up your response to those notices. Now, what we have clients questioning is, what if you're a new employer in 2019? Remember, the large employer status is always based on the prior year calendar hours. So for 2019, if you're a large employer, it was based on your hours for 2018. Well, what if you're a new employer? If you're a new employer in 2019 and you anticipate that you will have 50 or more full-time equivalent employees, then you're a large employer for 2019. You don't get to buy yourself another year. If you are a large employer or a small employer that acquires another small employer, so let's say I have 40 full-time equivalent employees, and on August 1st, I acquire another business, and that business has 40 full-time employees. I now have 80 as of August 1st. I'm a large employer as of August 1st. I would then have a filing requirement. Excuse me, federal individual mandate, like we said, that's been repealed, but look for those states that are having their own mandate. Misinformation out there that since the individual mandate is repealed, the employer mandate is repealed. That's not true. So then we get a lot of questions in our roundtable saying, hey, if there's no individual mandate, then why do we have to file our 1094 and 1095 forms? Well, the 1094 and 1095B forms, they could be questionable, right? So those are the forms that small employers with self-funded plans file, as well as insurance companies file. And those are forms that say, hey, Tanya and her husband and her kids had insurance for January, February, March, whatever months we had coverage for. Those were used for the individual mandate. The C forms, however, they're for large employers. And those forms are a little bit more needed, in my opinion, because the IRS marries those forms up with the 1095A forms that the exchange sends out. So if we have an employee that goes to the exchange, qualifies for a premium tax credit, receives that premium tax credit, the exchange will give that employee, as well as the IRS, a 1095A. The IRS is going to look at that 1095A as well as the 1095C from the employer and see if an affordable offer was made to that employee. We still have requirements for both the B and the C forms at this time. Another question that comes up is people will say, well, since there's no individual mandate, will we have as many penalties because there's no requirement to get health insurance? Probably the B penalties, I assume, would be reduced. Remember, the B penalties are those penalties that if an employer offers insurance to 95% of their employees, their full-time employees, and it's deemed unaffordable for someone, and that person goes to the exchange and receives a premium tax credit, that employer would get hit with a penalty, but just on that one employee. Versus the A penalties, those penalties are if I'm not offering insurance to at least 95% of my employees, and one of my employees goes to the exchange and receives a subsidy, that penalty is going to be triggered on all of my employees minus the first 30. We have a slide later on that talks a little bit more about this. But because it only takes one person to trigger that A penalty, I don't suspect our A penalty is going to go down due to the repeal of the federal mandate. The B penalty potentially, because we might have a couple less employees go to the exchange and receive a subsidy. But remember, it only takes one employee to trip that A penalty. Reimbursement of premiums. This is nothing new, but because I see it so often, I think it's pertinent that we talk about it yet again. So on February 13th, 2013, the IRS issued IRS Notice 2013-54. That notice says, listen, employers, an EPP, an employer payment plan, is considered a group plan, and because it doesn't meet the market reforms, just like an HRA, a health reimbursement arrangement, you cannot offer these to your employees. There's a $100 per day per person penalty on these. Obviously, they were still seeing this, so the DOL, in conjunction with the IRS and Treasury, came out with an FAQ in November of the following year saying, listen, we don't care if it's pre-tax or post-tax, you cannot reimburse anyone for individual coverage. Couple reasons, we won't need to get into those. Just know that you cannot reimburse for individual health insurance. There are a couple exceptions. With any rule, there's always an exception, right? So if you have an HRA with fewer than 2 employees, remember market reforms, they're not applicable to plans with less than 2 employees. So if you have a HRA for 1 individual, you'll pass the ACA rules. Then as they aren't applicable. You could have an HRA that's integrated with a group plan. I don't see a lot of these, but they are out there, they are allowed. HRAs that are HIPAA accepted benefits, those are your vision and your dental, those are still allowed. Remember, if you have these HRAs, you still need to pass the non-discrimination rules under 105H. So that brings us into these new ICRAs. They're an individual coverage health reimbursement arrangement, and they're new, coming up starting January 1st of 2020. Now I have 3 slides in here that talk about the ICRAs. I'm not going to go through the slides. You can read those on your own. Let's just talk about what the ICRAs are. There's some good and there's some bad that come with the ICRAs. Personally, when a new rule like this comes out, if I were a business owner, I probably wouldn't offer the ICRAs. We still have some additional guidance that's supposed to be released on the ICRAs. I think that there's a time and a place for ICRAs, and if I were an employer and I'd be backed into a corner and that was my only option, then I would look at it. Here's how the ICRAs work. So any employer of any size can offer an ICRA to their employees. So I could have 10 employees, I could have 1 million employees, and I could offer an ICRA. I can have group insurance and an ICRA, but I cannot offer those two to the same employee. So they've given us a list of 10 different classes that we can divide our employees into. So one of the classes, for example, is salary versus hourly. So I could say, okay, all of my salary individuals, I'm going to give them an ICRA. All of my hourly individuals, I'm going to give them group insurance. Maybe that's what works out for your entity. We don't have to worry about controlled group. We don't have to worry about offering the same thing as our related entities offer. We can put any dollar amount into those ICRAs. The nice thing about the ICRAs is the employer could say, all right, I'm going to fund the ICRA by $10,000 per year. You have to keep those ICRAs the same within the class. You can offer older individuals more money, but it can't be 3 times the amount of the lowest ICRA that's being offered in that class. So back to our example, I could say I'm going to give $10,000, put $10,000 in my ICRA for all of my employees that are salaried, let's say. What's nice about the ICRAs is maybe the group plan that my employer offers wasn't really what was great for everybody. The ICRAs, I can go out and buy an individual plan that fits my needs. So that's a nice aspect. You have to have individual coverage in order to get the ICRA. Otherwise, you're not eligible to accept that ICRA from the employer. Medicare Parts A and B would count, or Part C would count. We don't have to worry about the Medicare secondary payer rules if you're one of those employers that are subject to those rules. Another nice thing about the ICRAs. The ICRAs, another nice benefit to the ICRAs is that they do count for coverage under the employer mandate. So if I offer ICRAs to my all of my full-time employees, I'm not going to be subject to that 4980HA penalty. As of now, there's no dollar threshold at what dollar amount I need to put into that ICRA to have it count to the 4980HA penalty. If that ICRA is deemed unaffordable, I could be hit with a 4980HB penalty. Remember, that's the $3,000 penalty that we refer to as the B penalty. I could be hit with that if that employee says, thanks, but no thanks, I don't want that ICRA, it's not affordable, and they go to the exchange and receive a premium tax credit. I could get hit with that. Oftentimes, employers aren't worried about the B penalty because that $3,000 penalty, even though penalties are non-deductible, is oftentimes cheaper, if you will, than what the employer would have had to pay to have health insurance for that employee. Here's the downside of the ICRAs. Although I believe in the IRS FAQ, it mentions that it will be less of an administrative burden than group insurance would be. I think otherwise. If you have an ICRA, you need to give your employees, whoever's eligible for this ICRA, a notice 90 days before the plan year. Now, the IRS has an FAQ out there that explains these ICRAs pretty well. It's a I believe it's a 15-page FAQ out on the IRS's website. The first 7 pages will give you kind of a Q&A on the ICRAs. The last several pages are these notices and attestation statements that I'm going to talk about. The notice that you have to give to the employee 90 days out, the IRS has given you a sample notice that you may modify and use. That notice is 5.5 pages, and in my opinion, unless you're well versed in the ACA, you're not going to understand what it all means. So it's 5.5 pages. Your employees are going to get this. They're going to go to HR and they're going to say, I don't understand what this means. One of the reasons you have to give that notice to the employees is because if you are eligible for this ICRA and you take the ICRA, or if you say thanks but no thanks and you waive the ICRA, but it's deemed affordable, you are no longer eligible for a premium tax credit with the exchange. So it will state that in the notice. Well, let's say your employee goes ahead and says, nope, I want that ICRA. They got the notice, they think it's a great deal, they're going to take the ICRA. Then your HR department has to give them a couple attestation statements. And they need to turn in this attestation statement once you're eligible for the ICRA. So if your ICRA starts January 1st, they'll have to turn in this annual attestation statement saying, yes, I do have individual coverage, or yes, me and my dependents, the ICRA covers the dependents, have individual coverage. Then, once the employee has an expense that they want to be reimbursed, they have to sign a second ongoing attestation statement saying, I really did have individual coverage at the time that this expense occurred. As you can see, there's a lot of paperwork that's going to be going through your HR department. If you had 10 people sign up for the ICRAs, probably not a bad deal. If you've got 100 people that sign up for the ICRAs, I think it's going to be quite burdensome. If you're one of those employers that's had a hard time finding group insurance that worked out for you, maybe the ICRA is the answer for you, because like I said, it will count for the 4980HA penalty, so it would get you out of that penalty. So here are your several classes of employees that you can choose from. We talked about this slide. There is also, with the rules that came out, there is what's called an accepted benefit HRA. I don't think these are going to get a lot of traction. What these are is the employer in this case must offer group insurance. I don't need to take the group insurance if I were an employee for this company in order to receive the benefit. The benefit is $1,800. Now the accepted benefit HRA, just like the individual coverage HRA, and these are called ICRAs and EBRAs, just so you know, they are fully funded with employer dollars. So these EBRAs are nice. It's a way for an employer to give money to their employee pre-tax, but it's only $1,800 per employee. Excuse me. So Amy, let's do our polling question number 1, please.
All right. Polling question number 1. An employer has 90 full-time employees. Can the employer offer the 11 salary employee ICRA or the other 79 hourly employees group health insurance? That polling question is now open. If you cannot answer the polling question or you do not see it, please refer to the Zoom handout that was emailed out this morning. Chances are your internet browser is not capable with Zoom. We'll leave the polling question open for about 10 more seconds. All right, we're going to go ahead and close this poll. And here are the results.
Perfect. So 64% of you are correct. You can, remember, we can offer salaried employees the ICRA, and we can offer the hourly employees group health insurance. We just cannot offer the same group of employees a choice. That would affect our adverse selection in the insurance markets. So let's go ahead and continue on. So we talked about the magic number of 50, right? If you have 50 full-time equivalent employees, you are a large employer. It doesn't mean you have to offer insurance. It just means that if you don't, you still have the forms to file and you could be subject to a penalty. So full-time employee, what is a full-time employee? Well, remember, under the rules, if we're using the look-back measurement method, if we have someone who's hired as seasonal, variable, part-time, we would put them in an initial measurement period, that first 12 months of hire. Well, we've had employers come to us and say, well, no, all of our employees get hired as variable. And I said, well, let's back up. Let's look at your hours. And sure enough, their hours are all hitting 30, 40 hours a week. I said, under IRS audit, you're going to lose. If you hire someone anticipating that they're going to work 30 hours or more a week, they're going to come on as a full-time employee. Another thing the IRS would look at is what did you have for that when you were hiring that employee? What did that state? What was the job description? Who are they replacing? Are they replacing a full-time employee? If they're a full-time employee, you need to offer them insurance. Their waiting period can't exceed 90 days. Of course, you have to go back to your plan document. If your plan document says 60 days, that should be their waiting period. Excuse me. So we can look at a full-time employee status either by the monthly measurement method or the look-back measurement method. The monthly measurement method was really meant to be for those employers that have all full-time employees and all part-time employees, not those employees that have variable hour employees as their hours are up and down and all around. The monthly measurement method also is not meant for employees that use biweekly payroll data. That being said, I know we have those employers that probably do that out there, anticipating that the biweekly payroll data mirrors what a semi-monthly or weekly or monthly payroll data would be. The look-back measurement method, this is nice if you have those employees that have hours all over the board. Most employers choose a 12-month look back, and what that does, remember, is that spreads those hours over 12 months, and employers are hoping that those variable hour employees fall below 1560. That's 130 hours, which is your monthly count. times 12 months. If they do, by all means, you can offer them insurance, but they're not deemed to be a full-time employee, so you wouldn't need to give them a form unless, of course, you have a self-funded plan and they accept insurance. So these terms haven't changed. We have our waiting period, we have our monthly measurement period, we have our look-back measurement period. We talked a little bit about the initial measurement period already. I didn't put examples in this year about how those initial measurement periods play into the standard measurement period. All you really need to know for review is that initial measurement period, your variable and your part-time employees get an initial measurement period. In a perfect world, everybody would start on day one of your standard measurement period, and you'd have no hires outside that day. Then everybody could use the same 12 months to measure their employees. Unfortunately, that doesn't happen. So we take an initial measurement period. If you're using a 12-month period, you'd have the first 12 months of that employee's hire date, and then you'd have your standard measurement period, and wherever that employee is deemed full-time, that's when they need an offer of coverage. Remember, under the ACA, there are several instances where the employee always wins. This is one of them. Excuse me. So we talked a little bit about the stability periods. Remember, stability periods should align with your plan year. So we've got some people out there that have a calendar year plan. So that's their stability period. And they choose to not have an administrative period, which is fine. It's not required. And so what they do, for example, for your 2019 is they would use their 2018 as their measurement period. And then anyone who hits 1560 would be deemed full-time and would need a form in that stability period, which would be your 2019 calendar year. Hours of service. Remember, any hour that an employee is paid for is an hour that counts towards their hours worked. So if they're close to hitting 130 hours, make sure you're including all of these hours. Special unpaid leave. This applies to those employers that are using the look-back measurement method. So if I have jury duty for 2 months and you're using a 12-month look-back period, you're going to take the 10 months I worked, and if I hit 1,300 hours in those 10 months, remember 10 months times 130, if I work 1,300 hours, I'm deemed a full-time employee. We're going to talk here about a couple of rules that are commonly overlooked. So this rehired rule, if a business rehires an employee within 13 weeks of when they left, that employee comes on as an ongoing employee, not a new employee. I talked to several businesses, I talked to several insurance companies, and this rule seems to go just be kind of swept under the rug. People aren't aware of it. How this works is, let's say I quit in February and I come back in April. My employer would have to offer me insurance the first of the following month. Otherwise, if they had a 90-day waiting period or a 60-day waiting period, they can't wait that entire waiting period. If they wait that entire waiting period, they're going to have a no offer of insurance for those months when I should have had an offer. Be watchful. I see employers of every size employers, obviously the ones over 50, but any size employers. I see employers with 100 employees, 200 employees. This rule seems to be overlooked. Now for school districts, any type of educational institution, this now goes up to 26 weeks. I see a lot of schools fall under this, and unfortunately they're not following this. Let's give an example here, because maybe some of you sit on a school board and could bring this up to the school and enlighten them so they're doing it right. So if I have a teacher that has been working for me for 30 years, he retires in May, who is your best person that you want to hire back in September as a substitute teacher, as a football coach, as a bus driver? It's that teacher that retired in May. When he comes on in September, it's by all means not 26 weeks. You have to have an offer of coverage for that individual the first of the following month. Otherwise, you're not abiding by the ACA rules, and you're going to have a no offer of coverage. A no offer of coverage would be would be detrimental to the 95% test potentially. Remember that 95% test says if we don't offer 95% of our employees insurance, it's as if we offered no one insurance. And importantly, this is why some employers will say, I'm not using that monthly measurement method. I'm going to go back and use the Lookback. There's a good article on our website. It's a dated article. We came out with the article several years ago, but the information in it is still pertinent today. And what that says is if you use the monthly, you're more likely to trip that 95% test easier than if you use the Lookback. And how this would work is, let's say I have 100 employees. Just like any kind of Excel spreadsheet, any kind of payroll software, your output is only as good as your input. So remember, if you accidentally input something or you didn't input something right, you forgot to grab a cell on that Excel spreadsheet, and you offered insurance out of the 100 full-time employees, you offered it to 94 instead of the 95 like you should have. If one of those 100 employees goes to the exchange and receives a premium tax credit, you're going to be hit with that no insurance penalty. That's that 4980HA penalty. So you're going to take 100 employees minus 30. Remember, everybody gets 30 free employees. You're going to take that 70 employees and you're going to times it by the $2,000 penalty. You're going to pay that non-deductible penalty on top of having paid for insurance for those 94 people that your offer of insurance went to. So Amy, let's go ahead and do polling question number 2, if you will, please.
All right, polling question number 2 here. ABC Company uses the look-back measurement period of January through December. ABC Company's waiting period is 90 days. Sam has been a full-time employee for 15 years and terminates January 15th, 2019. On April 17th, 2019, Sam gets rehired. One second, my poll cut off. On April 17th, Sam gets rehired. When does Sam need to be offered insurance? That second poll is now open. The poll will be open for about 10 more seconds if you wish to answer. All right, we're going to end this poll. And here are the results.
Oh, well, that is bad news. Okay, so July 16th was the right answer. So 14% of you got that right. If Sam, and probably most of you don't have a calendar right at your fingertips right now, so I get it. But if Sam would have gotten rehired a week earlier, then he would have had to have that offer of insurance on May 1st. Turns out he's hired just after the 13 weeks, and ABC Company is not an educational institution. Okay, so here are your penalties. We still refer them to the $2,000 penalty and the $3,000 penalty. Obviously, they've ratcheted it up due to inflation. Like I said, we just round them down for easy figuring when we're doing our talking. Remember the no insurance penalty, that $2,500. We always get 30 free employees. One thing I should mention is that if you're part of a controlled group and you do get a notice from the IRS and you get hit with a pay or play penalty, and you didn't offer insurance, you're going to want to argue that penalty unless all of your controlled group members have the exact same amount of full-time employees working for them. What the IRS does is they take that free 30 and they divide it up. So let's say I have 5 entities that are all related. They would give each entity 6 free employees. Really how it's supposed to be based off of is your full-time employees. So if one entity has almost all of the full-time employees and just the other 4 entities have a few, the IRS should be dividing it like that and giving the larger entity more of that 30 number. I've talked to them several times asking them if they can switch their computer software as to how they pull that. They can't, but we'll gladly switch it if you ask them to. So we already talked about this, how about that 4980HA penalty works. Nothing new here. Remember, penalties are non-deductible. That offer of insurance, if it's unaffordable, remember it just takes whoever goes to the exchange to trip that penalty. So Amy, we are already on polling question number 3. Would you do that one, please?
Of course. Polling question number 3. What is the penalty for the employer with 51 full-time equivalent employees who does not offer affordable or adequate insurance to any of the 31 full-time employees, assuming one employee receives subsidy from the exchange? That third poll is now open. About 10 more seconds with the poll. All right, we're going to close this poll and hear the results.
Okay, the answer is 2,500. So remember, 51 full-time equivalent employees just tells me I'm a large employer. Now I have to file the forms. If I choose not to give insurance to those employees, and I had 31, remember I get 30 free employees, I'm only going to pay that penalty on one employee. So there is that, those employers that have this situation, that maybe they have only 30, 35, 40 employees, full-time employees, but they have enough part-time employees to trip them into being a large employer, so to speak. Some of those employers we're finding are saying, you know what, I'm not going to offer health insurance to my employees because the penalty is cheaper than what I would have to pay for health insurance. Again, remember, penalties are non-deductible. We have our safe harbors, same as it was last year. We have our box 1 of our W-2 safe harbor, we have our rate of pay safe harbor, and we have the federal poverty line safe harbor. That percentage this year is 9.86. Remember, that percentage is for plan years. We'll talk about that in a minute. The wages, box 1 of your wages, remember you take box 1 of your wages times the 9.86%. That's what an employer can't pay more than, an employee can't pay more than for their individual health insurance. And remember, it's single premiums only. Rate of pay, we see this one misused quite often. You don't get to take that rate of pay times 40 hours a week. It's cut off at 130 hours a month. So that's the maximum. So starting in 2020, we have a reduced percentage for our affordability. What does that mean? It means when you're looking at your insurance for next year, you need to have higher wages or lower premiums for that individual to have affordable coverage. Like I said, it's off of your plan year. So if you have an April 1st plan year, then that 9.78% would be effective as of April 1st. Down below are your percentages for the prior years. I don't think you're going to need 15, but 15 was 9.56%. So the notices, so these are a bit fun. The IRS is still working on 2015, but only for controlled groups. 2016 and 2017 notices are still coming out. The letter 226J notices, remember, those are your employer shared responsibility payment notices. In other words, they're your employer mandates. So they're coming out. What we're seeing is most of the notices that are coming out are due to having those forms being filed incorrectly. Remember, the output is only as good as the input. Make sure you're reviewing those forms once they're done to make sure that all the correct boxes are checked. One box being not checked on a 1094 seems to be causing quite a bit of heartache for a lot of employers. Employers only have 30 days to respond. Remember, that's the 30 days from the date of the notice. It takes about a week to get out of the IRS's office and onto your desk. Keep that in mind. You can call the IRS and ask them for an extension. I've had the IRS give us extensions all the way up to 3 times. and then they'll cut it off. Typically, I don't like to extend anything I submit to the IRS for these notices, but oftentimes some of the larger notices takes employers a while to get all the data to us to respond to them. Now, the Accounting Today magazine did have an article out there in August saying, hey, listen, the IRS isn't allowing as many extensions. I personally haven't seen that, but I haven't asked for an extension for a couple months now for any clients beyond the 30 days. They are recommending that people get their forms reviewed because the IRS is stepping up their enforcement efforts. So make sure that you give these forms to someone to have them reviewed prior to sending them to the IRS. So the letter 5699, we talked about those a little bit earlier. Those are the letters that IRS is sending out saying, hey, we think you're a large employer. Please let us know if you're an ALE. You'll need to file that response again by 30 days. If you're not an ALE, make sure you keep records of those hours and how you calculated that in case the IRS wants to look at them. Remember, if you have over 250 forms, even if it's a prior year forms, you do need to file those electronically with the IRS. Here's what we're finding. Some of those older forms, the payroll software companies don't allow those to be uploaded to the IRS any longer. So you're going to have to find someone that can upload those. There are some payroll softwares out there. Some of them are backed up, so you're going to want to be cognizant of that. Get on that early. Otherwise, you will get a penalty if they're not e-filed. And that penalty will actually come via Notice 972 CG. This is a civil penalty, and that's being issued. Actually, this just started coming across my desk for the year 2017, and I just started seeing this this summer for clients. This is a notice if you file your forms late. If you paper filed your forms and you were required to e-file your forms. They can also put this penalty out if they're incorrect or missing TINs. I haven't seen it for that yet. I'm assuming that is coming down the pipeline. Look for publication 1586 if you'd like more information on this notice. 1095B, 1095C, remember those B forms are for if you have a fully insured plan, insurance companies are sending those out. If you have a self-funded plan and you're a small employer, you have these to send out. If you're a large employer, you always have a C form to file. Insurance companies will not file that form for you. So Amy, you want to do polling question number 4, please?
Sure thing. Polling question number 4. Who files Form 1094C and 1095C? That poll is now open. We'll leave the poll open for about 15 more seconds. Okay, we're going to go ahead and close the poll and hear the results.
Awesome, 77% of you are right, all of the above. So once you're a large employer, you have the C forms to file, regardless of how many full-time employees you have. So I put the 1094C forms in here. We have them for 2018. Like I said earlier, we don't have them for 2019. So what I'd like you to do is look at your forms while I go through some common errors that we find in the 1094. This is probably causing the majority of the notices that I see come across my desk from the IRS is the 1094 is not being done correctly. Excuse me. So make sure your business name is listed exactly how it's listed for your EIN. We see lines 18 and line 20 not always being equal. There's a time and a place for them not to be equal. Very few and far between should that happen. and the ones that should have that happen are still doing it incorrectly. So if you have a division versus a separate entity, those numbers could be different on line 18 and line 20 as far as the amount of forms you're filing. Misunderstanding line 22 eligibility. Remember, line 22 on that 1094C says check all that apply. Not signing the form if you're filing that or sending that in paper, because obviously you're under 250 forms. Make sure you sign that form, sign and date it. On page 2 of the 1094C, over and over again, I see all 13 rows are filled out. If you're going to fill out the all 12 months, you don't fill out the January, February, so on and so forth for each month. You either do all 12 months or you do each individual month. The counts for B and C, I see those done incorrectly. They're right in the IRS instructions, and they haven't changed over the past several years. Not listing on page 3 if you have related entities. Those related entities on page 3 of the 1094 are supposed to be in descending order as far as the related entity with the most full-time employees should be listed first, then the second most, then the third most. And if you're filing your 1094, your name would not go on page 3. Here's your 1095C form if you want to look at that while I talk about the different lines where we see some errors. Line 14, I see clients that say, Tanya, can you review my forms? And I review the forms, and first blush, when I open it up, I see all of the line 14 boxes are not filled out. You have to fill out every single month on line 14, regardless if you offered coverage or if you didn't offer coverage. If you want to, you can use the all 12 months box. If you don't use the all 12 months box, you have to use each individual month. Again, don't use all 13 boxes. It's one or the other. There's never ever a case where any like half of the year of that line 14 should ever be blank. Line 15, always put cents in. If you're required to fill out line 15, enter the cents. If it's $100 that the employee's paying for coverage, it's actually 100.00. Line 16, safe harbor. This doesn't always need to be filled out, but be cognizant of when it needs to be filled out. If you're using a 1A or a 1G, you don't need to fill out line 16. If you're not offering insurance, by all means, you're going to have a 1H for a no offer on line 14, and then you're going to leave line 16 blank. Line 16 is your safe harbor. I like to think of it as your excuse. What is your excuse for doing what you did? If you didn't make an offer, you don't have any excuse. It would be blank. If it's affordable, you have to enter a code in as to why that's affordable. I see some companies, and I think it's a setting in their payroll software, that they will send out forms and they'll use a 1E code for line 14 and they'll use a 2C code for line 16 if they accept coverage. But if the employee waives coverage, that line 16 code is by default left blank. Well, honestly, those employees that waive coverage, those are typically the employees that could cause you a potential penalty, because they could be the ones going to the exchange and getting a policy off the exchange, maybe with a premium tax credit. That would then cause you a penalty because you told the IRS you offered them insurance, a 1E code, but you didn't have a safe harbor. So what that means is if line 16 is blank, you're telling the IRS it was deemed unaffordable and you should be hit with a penalty. So if you're offering affordable coverage, please make sure you put those safe harbor codes in on line 16. Obviously, part 3 on the 1085C is if you're self-funded. Common coding. If you can use a 1A code, use it. Less is more when it comes to giving the IRS information. If you can, if you're offering insurance that is $99.75 per month for the employee to pay, and that's for a 2019 plan year, then use a 1A code. The nice thing about the 1A code is you don't need to put anything in lines 14 or lines 15 and line 16, and it's just deemed affordable because it's a qualified offer. We talked about the 1E code. Make sure you put in your safe harbors. So in 18, if we had a union employees, we were able to use a 1H2E, an easy code. We'll see if we get that for the 2019 instructions. Like I said, we don't even have draft instructions out yet. I'm assuming we'll still have that. I haven't heard any word that we won't. A 1G, those are for your non-employees. If you have a board of directors and you're offering them insurance and they take insurance and you have a self-funded plan, that would be a 1G code. If you have employees that have been part-time all year and they take your insurance, and you have a self-funded plan, again, you use a 1G code. This 1G code seems to be misused all the time. If you're going to use it, you have to use it for all 12 months. No exception. Because that would be for employees that are not full-time, you don't need to put anything, and you shouldn't put anything in lines 15 or line 16. Less is more for the IRS. We're going to go through some examples now. We'll probably, we might have time to get through all of them. If not, we'll skip to the last one, as that's a pretty good example. So Lisa starts working full-time for an employer on January 4th of 2019. Her waiting period is 60 days, and she waives coverage, even though the offer is only $93 a month. Here's what her 1095C would be. Now, someone would come up to me and they'd say, well, why would March be a 1H2D if she was offered coverage partway through the month? Remember, to use a 1A code has to be, that offer has to be out on the table for that employee the entire month. April through December, we don't need to put anything in lines 15 and 16 because we're using a 1A code. It's just deemed affordable. Example number 2, Steve starts working part-time on February 15th for the employer. They use a 12-month look-back measurement method. March 1st, he takes a full-time position and has offered insurance the following month at $93 a month. His 1095C would be January 1H2A, no offer of coverage because he wasn't working. He was not an employee any day of the month. February and March, he's in his limited assessment period. So February, he gets hired. March, he flips over to a full-time position, gets that offer on April 1st. So someone would come to me and say, well, Tanya, if you're using a look back and he was hired part-time, why does he need a form? Don't I get 12 months? Remember the rules for a new hire. If you switch someone from a part-time position to a full-time position and they're in their initial measurement period, they need an offer of coverage as they're deemed a full-time employee. Otherwise, all employers would hire everybody as part-time and the next month flip them to full-time and buy themselves a 12-month time period where they didn't need to offer them insurance. So again, if someone flips to a full-time position within that first 12 months of hire, if that's what your look back is, you need to have an offer of coverage to them. Same example as the prior example, but let's say that Steve has worked part-time for 10 years. Now on March 1st, when he takes that full-time position, we don't need to give him a form even if he was offered insurance. If you want to give him insurance, great. If you have a fully insured plan and he takes the insurance, you don't need to give a form to him. Remember, every form you put out is a potential penalty coming back in. Excuse me, if you had a self-funded plan and Steve took the insurance, he would be a 1G code. That's basically telling the IRS, listen, I'm just giving him a form because I need to report the information in Part 3 for the months he had coverage. Example 4. Jane works full-time for an employer that uses the look-back measurement period for 10 years. On January 15th, she takes a part-time position and averages less than 30 hours a week for the remainder of the calendar year. Jane was offered insurance that met minimum value when she was first hired at $95 a month after, of course, her waiting period. The employer drops her coverage effective January 1st of 2019. She doesn't take COBRA as it's deemed unaffordable. So one of the rules that we didn't talk about in our presentation today is when you're in your stability period, typically you're locked in to whatever you are, right? If I was a part-time employee due to the look-back measurement period, I'm a part-time employee in the stability period. You don't have to offer me an form, and you shouldn't give me a form unless I have a self-funded plan. Excuse me. There is a rule out there that says if I worked full-time hours in my look-back measurement period, and then in my stability period, I'm deemed full-time. If I take a part-time position in that stability period, after I work an average of 30 hours a month for 3 full consecutive months, and if I was offered insurance that met minimum value when I was first hired, you can drop my offer on the first of the 4th month and measure me monthly there on out until the next stability period. So that is what is going on here. Her January form would be a 1A because she was offered coverage. Effective January 31st, however, they drop her coverage and they really shouldn't have. February through March, she would have a COBRA, or I'm sorry, February through April, she would have a COBRA offering. However, that COBRA is deemed unaffordable, so I don't get a safe harbor for line 16. So if Jane actually wanted to go to the exchange and if she qualified for a premium tax credit, receive that premium tax credit, I would get hit with that $3,000 penalty divided by 12 for each month, February through April. May through December, we can put in a 1E, the COBRA amount, and a 2B telling the IRS, listen, she's now deemed a part-time employee. I don't have to have that offer to her. Obviously, I ran out of names, so Jane is now terminated. This is Jane number 2. So Jane terminated employment on April 30th. Prior to her termination, she was full-time and enrolled in coverage at $96 a month. Her COBRA continuation coverage is $800 a month. What does her 1095C look like? Well, January through April, it's a 1A. We're going to assume she took her COBRA coverage. May through December, whether she takes it or doesn't take it, it's a 1H2A. She is not your employee. So a 1H2A just simply says she didn't work for you any day of the month. Now, if you had a self-funded plan, and she took coverage for the entire year, doesn't change the part 2 of my 1095C, but down below in part 3, I would check all 12 months that she had coverage. If it's a self-funded plan in the next year, we would give her another form, and it would have a 1G, and then the boxes down below in part 3 for whatever months she had coverage. Okay, so example 6, employer as an ALE offers insurance to those employees who work 20 hours a week. The insurance is offered to the spouse and dependent. It meets minimum value, minimum essential coverage. Drew works 1,440 hours and enrolls in coverage. This is not a self-funded plan. What would his form be? Well, it's nice that they offered him insurance. Whether he enrolls or doesn't enroll, it's not self-funded. He does not need a form. Last example, Samantha works full-time for this employer. This is a very, if you get this example, you get it all, you're great. So let's go through it real quick, then we'll hit a couple other slides and maybe have a minute or two for questions. She works full-time January through May due to the Lookback Measurement period. She's enrolled in coverage. She terminates June 4th, however, coverage terminates on the day of termination. She gets rehired August 2nd and is offered insurance November 1st. The coverage is $102 and it's deemed affordable. She doesn't take COBRA coverage. And like I said, coverage ends the date of termination. So January through May, she's a 1E, 102, 2C. She took coverage. June, however, remember, coverage ends the date of her termination. So June, we can't use a 1E because she didn't have that offer for the entire month. So we put a 1H, 2B in there. July, she didn't work for the employer, so we're going to put a 1H2A in there. August, she's rehired, so we're going to give her a 2D for that month. That's our safe harbor. That's our excuse code. We shouldn't have to have a penalty on those months. She was rehired within 13 weeks. We should have had an offer of coverage September through October, so she's going to be a 1H blank. November through December, she's a 1E, $102. Line 16 would be a 2F, 2H, assuming she waived coverage and it was deemed affordable. Here are your penalties. So if you want to look at those 972CG penalties, here they are, depending on your size of business. So here are some common misconceptions out there. The biggest misconception I see is that they think insurance companies file the forms. They will never file your 1095C forms. If you do have an insurance agent that does that, I would be surprised. I would have them put that in writing and show proof that they e-filed it to the IRS. We have seen some clients that file their forms from the IRS to the IRS, but they didn't get through the system, the electronic filing system through the IRS, and the IRS then penalizes them because they never got confirmation back. They just assumed since they submitted them in that they got to the IRS. I've also seen it where they thought the payroll entity uploaded them. The payroll entity says, no, we weren't supposed to upload them. You were supposed to push it through to the next step. Be careful, make sure they get to the IRS and keep that confirmation that they did get there. Remember, don't reimburse for those individual premiums. If you want to do an ICRA, look into the ICRA. There's a time and a place for those ICRAs. They work for, in my opinion, few and far between employers right now. So here's what we can do to help you if you need our help. I think most of you on the call are probably our clients already, but there is what we offer. I think I have 2 minutes for questions. Amy, are there any?
Yes, there is one question here, and it says, I forgot to mark a box on my 2017 1094-C. Should I file a corrected form?
Absolutely. I would try to beat it before the IRS sends you a notice. So once the IRS sends you a notice, you can't amend or correct that form. Go ahead and correct that form. Obviously, keep a copy of it. And then what I tell employers to do is I tell them to overnight it to the IRS and keep that, it's on the tip of my tongue, that confirmation that it was mailed. Keep a copy of that receipt in the file. So if the IRS comes back and says, hey, you owe a $100,000 penalty, you can say, oh, you must not have seen this. It must not have gotten through the IRS's system. And I'll be honest with you, we have helped clients amend their forms, and it takes the IRS quite some time to get to those amended forms if they've gotten to them at all. But it's a whole lot easier to say, hey, listen, you forgot to look at this corrected form, and then it is to respond saying, hey, Sally did have an affordable offer. We did offer coverage that met minimum essential coverage and minimum value. Here's our backup. Remember, if you read that Accounting Today article, it's going to say there's a little bit more enforcement now. So you're going to want to step up your efforts. If you get one of those notices, you got to prove yourself a little bit more to the IRS, not just maybe say, yes, that was checked wrong. So I would still recommend going ahead and correcting that.
All right, if anyone does have any other questions, you can use the Q&A box or you can use the chat feature. All right, well, you can see that Tanya's contact information is up on the screen if you do have any questions. We thank you all so much for attending, and thank you to Tanya for presenting.
Thank you. Thank you, Amy. Thank you, everyone. Have a great afternoon.
You too.